Good morning, Quasar Markets Live. So happy to be joined here by Dr. Alan Ellman, the president of the Blue Collar Investor, a guy who gives us so much of his time, and we really appreciate it. Dr. Ellman, how are you doing today?
Wonderful, Howard. Glad to be with you.
Glad to have you. We have an exciting one. I know that I have been trying to sort of narrow down. I have a very good understanding of the Greeks in general, but the question I had for you that you have been so nice to put this presentation on about is how do they actually apply to your strategy? You know, what should I be looking for in the Greeks to make it easier to make my decisions when it comes to either covered call writing, cash secured puts, and the method that the blue collar strategy is, the BCI method. So,
Yeah, it's important to understand how the Greeks impact the option pricing and the risk of our trades. Most of the time, it's not critical to actually go up statistically and look up what the Greek stats are, although there are times when we choose to do that. But the concepts of how these factors work in our covered call writing and cash secured put trades is very, very important.
absolutely, without a doubt, is sometimes so important. And what I like though is that you've broken it down, so I'm not looking at every, and we see it right here as we go into the option Greeks. I don't have to know everything about all five to make these decisions, right?
Well, you have to have a general idea as to how these factors work in our trades. But of the five Greeks, delta, gamma, theta, vega, and rho, the ones that are really important in our covered call writing and cash secured trades are the three that I've highlighted in yellow: delta, theta, and vega. Now, gamma is really a second generation delta, or the delta of deltas, or how much the delta will change for every $1 change in the price of that underlying security. So just focusing in between those two on delta is sufficient. Now, rho, I didn't highlight either, and that's the amount that an option price will change for every 1% change in the short-term interest rate.
Right.
Now, as you know, most of the time interest rates aren't changing, and when they do, they change by maybe 25 basis points, sometimes 50. But rho is not considered a major Greek. So, for purposes of this discussion, Howard, I felt we should focus in on the three really critical ones, which are delta, theta, and vega.
Makes sense. Absolutely. There, like you said, Row, you don't see used as much because our interest rates luckily don't fluctuate as much in a shorter time frame that we're looking at here, like you talked about, and with gamma being the second generation or a derivative of delta, how delta performs narrows it down a little bit for us. Let's talk about delta.
Okay, delta sometimes is a little bit confusing to beginning option traders
Yeah.
or retail investors because it actually has three definitions. The definition that probably most option traders are familiar with is the first bullet, which is the amount that an option price will change for every $1 change in the price of the underlying security. So if a particular option has a premium of $2, and a delta of 50 or 50%, and the price of the stock goes up by $1, we would expect the price of that option, the value of that option, to go up by 50% of $1, so from 2 to 2.50. If it went down $1, from $2 to $1.50. So
Right.
that is the definition that most option traders are familiar with as it relates to delta. And this is important to us in something that I've talked about probably quite a bit since we started these discussions, and that are the 20%, 10% exit strategy guidelines,
Yeah.
which helps guide us when to buy back the short call, short covered call, if the price of the underlying goes down. So it helps protect us from share price decline. And a lot of people will say, well, if I'm doing an in the money strike, which has an intrinsic value plus a time value component, does the 20%, 10% guidelines apply to just the time value or the entire premium? And delta shows us that it should apply to the entire premium because delta goes down more for the in the money strikes, which have higher deltas. A little complicated to throw out at the beginning of this discussion. But the bottom line is that delta helps teach us that when you're using these buyback guidelines, that it should be on the entire premium, even if it's in the money.
Right. Absolutely. That is important to know. Because some people get nervous there and don't know the difference between the two, the in the money and the out of the money for it.
Yes, and another thing that delta is critical for people that want to use options as a surrogate for the stock. Let's say in the poor man's covered call, where you buy a deep in the money leaps option, long-term expiration, and you want that to simulate the price of that underlying stock. Well, you would want to use a deep in the money with a delta, let's say approaching 1 or 100, depending on if you're talking about a share or a contract.
Right.
So normally I would set up a guideline of deltas between 75 and 100 as far as, being a stock surrogate for the poor man's covered call or any other strategy where you want that option to replace the stock.
Right.
So that's the first. Now that's only one definition of delta we've talked about so far.
Absolutely.
Now the second bullet, Howard, is something that applies more to high wealth portfolio managers who are seeking what's called delta neutral portfolios. So here's how it works. Delta is this is the second definition now, the equivalent number of shares represented by that option's position. So let's say you buy a call option with a delta of 60. Well, that means it represents 60 shares. So you plus 60. Let's say you buy a put option, which has a negative delta, with a delta of 60 minus 60. Well, that means you short, the equivalent of being short 60 shares. So what these portfolio managers do is they add up all their plus deltas and their minus deltas, and they want to come as close to zero as possible to get a delta neutral portfolio, which then minimizes market risk. So that particular definition applies more to these high wealth portfolio managers.
Yeah, I didn't even know that one because that's not me.
Well, but sometimes people will read something and say, wait, Alan or Howard they never mentioned
Right.
that. So I want to kind
And
of.
I do know about delta neutral portfollios. It's just I didn't even think about it as being part of the equivalent number of shares represented. I do know that many strategies are based upon being delta neutral. And we started a lot with Bitcoin, right? In the early days when people were worried about the volatility there, where we saw a lot of that.
Yeah. So just for purposes of being thorough, I wanted to give all three. Now, a very, very important third definition of delta is the percentage likelihood. I should have used the word approximate also in there. Percentage likelihood that on expiration, an option will expire in the money or with intrinsic value, which means subject to exercise. Now, sometimes you're going to want a high delta, and I'll get into that in a second. And most of the time, you want a low delta because you don't want exercise. So it depends on what your strategy goals are, and that will help dictate which strike deltas you should be favoring. So let me give you see I had three subtitles there underneath that third bullet. The first one says portfolio overwriting. Now, portfolio overwriting applies to those that are doing covered calls on shares they want to keep. Perhaps they're long-term buy and hold positions at a low cost basis in non-sheltered accounts. And if the shares are in fact sold as a result of option exercise, they may have some negative capital gains issues to deal with, and they don't want to deal with it. So what do? When you set up that deep out of the money strike way higher than current market value, you can actually look at delta to determine and actually quantify what your risk is. So for example, if you set up an at the money strike, which you wouldn't do for portfolio overwriting, with a delta of let's say 50, that means 50-50 chance that it'll expire in the money, which you don't want. So you need a much lower delta. So you're going to go way higher than an at the money strike and go deep out of the money, maybe with a delta of 10 or 15 or whatever. And that means that there's a approximate probability of 10% expiring in the money. And then, of course, you always have your exit strategy arsenal to avoid
Absolutely.
exercise by buying back that option prior to 4 p.m. Eastern time on expiration Friday.
Yep. Yeah, I use it a lot for that. I will say for sure. You know, 1 and 3 are the two ways that I use it the most, and 3 being the one that I use the most, quite honestly, when I'm trying to decide. Like you said, a lot of times I'll be doing the poor man's covered call or leaps. It becomes very helpful for that a lot of times.
Yeah, and so the delta has application in many different ways using
Yeah,
these strategies that can be crafted also in many different ways. So
sure.
let's say I was selling a deep out of the money cash secured put, right? Well, when we go deep out of the money, most of the time, the investor does not want to take possession of those shares. They
Yep.
just want to generate cash flow. And so what you're going to do is you're going to also go for a very low delta.
Yep.
Let's say we do a delta of 10, keeping in mind for puts, delta have a negative sign because they're inversely related to the price of the stock. Well, that will help dictate. Oh, so if you have a delta of 10, well, there's only approximately a 10% probability of that strike expiring in the money. In other words, the price of the stock going down so far that it goes lower than that deep out of the money strike, which is now in the money.
Yep.
So again, you're going to want to select a low delta for that. The third bullet subtitle here, Howard, is deep in the money calls. Now, this is a very, very defensive covered call position because you're selling a call strike much lower than current market value, which means you don't care
If it
if your
gets taken
shares
away.
are taken away. All you
Yep.
care about is cash,
Premium.
time value cash. So what you do is you set up your trade to generate a certain amount of time value cash, forget about the intrinsic value component, let's say 2% a month, with a huge amount of protection to the downside. So you don't want the price of that stock falling from here all the way down below that deep in the money call strike. So
Right.
once again, there you're going to go for a very high delta because you want that strike to expire in the money. You don't want that price of the stock to drop so far that you start losing money. So that
Right.
would be an example where you want a very high delta strike price.
Absolutely.
Now I just
You
put this.
broke down 2 on a graph. I love this.
I like to show things graphically because
Yeah.
sometimes if things are a bit confusing, by showing an image, it kind of brings everything together. So this just goes to show delta as it relates to the moneyness of a strike. So let's start on the bottom left with out of the money calls have deltas, let's say between 0 and 10. So very low delta. You would go deep out of the money if your portfolio overwriting and you don't want your shares sold, right? So there's about a 10% approximate probability of exercise. Now, if we go into the middle of the graph at the money with deltas of about 50, that means there's about a 50-50 chance of that option expiring in the money or with intrinsic value. So that would be the at the money. Now, the at the money strike also gives you the greatest time value return. So a lot of investors are focused in on the at the money strikes, which are fine. I mean, it's fine, but you don't get any opportunity for upside potential if you sold an out of the money call, and you
Yep.
don't have any additional protection in the money if you with the intrinsic value component if you sell an in the money call. So once again, define your strategy. What are your goals? What is your personal risk tolerance? Are you bullish on the market? Are you bearish on the market where you want to have a defensive trade, in which case you go in the money, and then that will kind of lead you to a particular delta as well. Finally, Howard,
Absolutely. That helps a lot. I made that mistake when I was a beginning trader, you know, trying to do a version of the poor man's covered call and buying at the money, then selling out of the money, you know, ones and trying to profit there. And what you find out if you don't do that correctly, it quickly eats away and you end up on the bad side of that trade.
Yeah, there's no free lunch in our trades.
Yeah, that's for true. You think you found something that no one know. It is funny as you mature as a trader because I had, 3 or 4 epiphanies where I thought I had cornered the market. I figured out something nobody ever figured out. And as soon as I brought them to people like yourselves that had been in the market for years, you point out, yeah, did you think about this part? And I'm like, oh,
Yeah,
okay, yeah, that was,
I think it would be one of the things that I feel I do for people that are listening to me at my webinars or live seminars or whatever is I let them know that if you're seeking an extremely high return on your option trades, that by definition means that you're incurring a lot of risk to the
yes,
downside.
yep,
Now, I'm not saying there's anything wrong with that. I'm just saying that your trades have to be crafted to align with your personal risk tolerance. Now,
yep,
I'm a conservative investor. I'm willing to incur low risk, not high risk. So
yep.
all my trades are crafted based on that. And believe me, you could still generate significant returns. I use the analogy, a baseball analogy. I hit singles and doubles all day long, but I'll never hit a
Absolutely.
grand slam home run. Never.
But as I've also pointed out, Wade Boggs made millions of dollars doing that for years for the Red Sox and your Yankees.
That's right.
There's nothing wrong with that. And it goes to what I would point out to people is even if you are aggressive, having, we talked about this before we came on, it's portfolio diversification. You shouldn't have all your eggs in one basket. And to me, that also means in your risk, of each trade. It's okay to have a few YOLOs as long as you have a strong, sturdy portfolio of more well-balanced trades. I like to have fun like everybody else and take a flyer on earnings once in a while, or, Powell puts or something, as I like to call him, as he's getting ready to talk. But it should be a small percentage of your portfolio, not a large
Yeah,
percentage.
that's great advice. Okay,
Okay, so
the
I
next
actually flipped this over to theta here by mistake when I was talking.
no, that's okay. That's okay. This is a good place to be. Okay, so we talked about delta. The second of the three important Greeks is theta, which is time value erosion, and it's an estimate of how much the theoretical value of an option will decline with the passage of one calendar day. So if I were to say to your viewers, think of it this way: you buy a car, right? You drive your car out of the dealer parking lot, and what happens? The car is worth less.
Yeah,
What happens a month later? It's worth even less. A year later, even less. So the value of that security or the value of that car goes down with the passage of each calendar day. Now, while I'm on the calendar day business, um, a lot of people ask me, should I enter my trades on Friday so I don't lose the time value or theta from Saturday and Sunday? Because it's based on every calendar day,
yeah, right.
including the weekends. So actually, the way it works is market makers will actually deduct the theta on Fridays.
I was about to say, yeah, they're already on that.
They're on that. So there's really no advantage of taking the weekend risk if you want to avoid that. You can enter your trade on Monday and not worry about losing Saturday, Sunday. But anyway,
Absolutely.
that is the definition of theta, and it helps us in determining when to enter our trade. So let's say, Howard, we're doing covered calls or cash secured puts weeklies. Well, because of theta, time value erosion, we know we don't want to wait for Wednesday to enter our weekly trade because theta will also be eroding away our time value. We want to
Yep.
get that trade in on Mondays. You know, now if we're doing a monthly, okay, Monday or Tuesday. But again, the time value erosion is something we must keep in mind with these short-term option strategies.
Absolutely, especially if you're selling them because that, you want to get that premium as high as it can be for each strike, right?
Absolutely. You want to get as much premium. An exception to the rule might be, if there's an earnings report on Monday, okay, I'll let that pass and I'll
Yeah,
come back on Tuesday. But otherwise, yeah, I do my weeklies on Monday, my monthlies on Monday or Tuesday. Theta also helps us determine when to enter, in addition to when to entering our trades, how to use our 20%, 10% guidelines, which I alluded to before. And
Absolutely.
if you take a look at the image, Howard, that I added to this slide, specifically that red line. Okay, the
Absolutely.
red line is near the money strikes, the kind that we use for covered calls or cash secured puts. So it's a strike price close to the price of the stock at the time we execute the trade. So if the stock is trading at, let's say, 50, we might be doing a 52 or 53 strike, or 48 or 47 strike in the money. Now, if we're doing special circumstances like portfolio overriding, we might do a 60 strike. But let's talk about traditional, where it's near the money. And that's what that red line represents, the time value erosion for, let's say, a monthly option. And you could see that the erosion, Howard, is logarithmic in nature. In other words, it's not like a deep in the money strike, the blue line, which is linear. It starts out really slow. So the time value erosion starts out very slowly, and then on the right side of that red line, it just falls off a cliff. So there's more opportunity through exit strategy manipulation to generate additional time value profit earlier in the contract than later in the contract. That red line clearly shows that.
Yep.
And that will dictate why we're using the 20%, 10% guidelines. I'm willing to spend more money, 20%, to buy back that option early in a monthly contract. I'm not willing to spend as much money. I leave it at 10% in the latter part of the contract. And if you could just remember that slide, that explains why.
Absolutely. And it really starts taking off, if I'm not mistaken, at 30 days, right? Is when it really starts to kick off, and then 15 becomes the next big number to worry about.
Well, this is showing you pretty much the way a monthly works. So
Okay.
for the first 2 weeks, it's like incrementally, it'll start declining slowly, and then in the last 2 weeks,
It just takes
it'll
off. Yeah, that
fall off the
15
cliff.
days I knew was
So that's why I use 20. It took me a couple of years to figure this out. The 20% in the
right.
first half of a monthly, 10% in the second. I was trying all different combinations back in the 1990s, and this is the one that works the best. And it's worked well for me for about 3 decades now.
Awesome.
Also, Howard, there are certain exit strategies. I know you have my book on exit strategies,
Yep.
which will also, that red line will dictate which strategy to select. So, for example, if it's in the first half of a monthly contract, you're more likely to use hitting a double strategy, which is where the 20% guideline was reached, the option was bought back. Now, what do? Well, I'm more likely to wait a couple days and see if it comes back up again, so I could sell the same option
Yeah.
twice in the same contract, because the time value hasn't eroded that much. In the second half of a contract, though, I'm more likely to roll down if that
Right.
10% threshold was reached. And all this plays together.
Absolutely. It's beautiful. And for our viewers, please go back and take a look on either our Twitter or especially YouTube, where I've put them all together. I believe this is the 16th episode that we've done with Dr. Ellman, and we've gone over his exit strategies and also the 2010 rule on some of our past ones. So go back, take a look at those. Great information that you'll be able to understand a little bit more what we're talking about.
Okay, we can move on now to
Vega.
Vega, the third of the three important Greeks. And this one is I don't like to quantify them, but this is really important. Implied volatility. So Vega is defined as the amount that an option price will change for every 1% change in implied volatility. So this is the pitfall that most retail investors get into when it comes to trading options, because the higher the implied volatility, the more volatile an underlying security is, the greater the premium. That's
Yep.
the good news.
Absolutely.
You get more premium. And what kind of security is the average retail investor or beginning options trader going to be attracted to? The one that brings in the most money.
Yeah.
However, underline that word however about 16 times. The greater the implied volatility, the greater the risk to the downside. So if I have a security that generates what my goal is, which is 2 to 4% a month, 1/4 that amount. You can see on that bottom bullet. If I'm doing weeklies, within that premium is the implied volatility. I don't have to look it up. I know that that meets my comfort level. 2 to 4% a month, 1/4 that for weeklies. I know that that meets my comfort level. But if I'm taking a look at a near the money strike and it's giving me 8% in a month, I don't want any part of that.
Yeah.
Now, a lot of people might be scratching their head. Alan, 8% in a month. Come on, get with the program. Well, there's too much risk to the downside. There's no
There's
free
a
lunch.
reason you're being paid that much for it, because there's a good chance that it's going to go away, maybe.
Well, not only go away,
Or that, or there's a good chance it doesn't get anywhere near it.
but it could go away, and then you have to dig into your pockets.
Yeah, absolutely. Yeah. No, I mean that, it's important for people to understand that, because you'll hear so many new educators all over YouTube that will tell you you gotta buy IV only when it's at high levels. It depends on what you're trying to do. There is no one answer, I would say, to any investment. So I do think it's important to understand that, because you will see, even here on Quasar, some other educators that will talk about they only buy volatility when it's, they only sell for premium when it's high volatility. That is the case if you're a very risky trader that's looking to do a very different than this covered call in the BCI strategy. So I just wanted to point that out.
If you're willing to incur high risk, there's nothing wrong with an 8% monthly return or higher.
Absolutely. As you know, I live in the world of crypto where everything is, volatile. So it all depends on what you're trying to do and what your goals are.
Yeah. Howard, can you go back to that last slide? I just want to make sure I made all my points. Okay. So I kind of did make this point already, but the implied volatility is actually inherent in the time value percentile returns of your options, and that's the reason why you don't specifically have to look up the IV of every particular trade you're making.
Right. If you're following your guidelines, they're going to fall into the correct range based upon the percentage that you're going to get in premium.
Okay, so here's what I did for Quasar viewers. On 2/4, I created this screenshot. I combined two screenshots taken from cboe.com, one for Shopify, a very highly volatile security, and the other for eBay, which has a much lower implied volatility. So watch this, Howard. Let's take a look now at Shopify, which was trading at 119.07 on 2/4, and this is for the February 21st expiration. So it's a little more than 2 weeks out. Now, I highlighted in brown Shopify the 120 strike, so slightly out of the money, 119.07 to the 120, slightly out of the money strike. Now, to the left of that, you see that the implied volatility, look at this number, Howard, 85%. It's huge. It's huge. And look at the bid price, $8.35. We're going to make some sense of that in the next slide. Okay. Now that's the volatile stock. Now, right below that, for purposes of comparison, I'm using eBay. Now, eBay at the time was trading at 67.20, same day, 2/4 for the 2/21 expiration. So these were done one after another. Yep. Now we're going to look at the 68 strike you see on the bottom right. Slightly out of the money from the 67.20 current market value. So both of them are similar, slightly out of the money call strikes. You'll notice the implied volatility in the middle in yellow was 24% compared to 85% on Shopify. The bid price for that 68 strike was $1.07.
Yeah.
Okay, so let's just review this before we put it into the spreadsheet. Shopify, which had the 85% IV, 120 strike, 835. eBay, which had the 24% IV, 68 strike, $1.07. I put this into the BCI trade management calculator, and there we go. So now on the top part of this slide, you could see in the yellow on the top I put in the data for eBay. Okay, trading at 67.20 in the yellow cells at the top. The 68 slightly out of the money strike generated $1.07. Right underneath that in the brown row, we have Shopify, the very high implied volatility security, which was trading at 119.07. We used the slightly out of the money 120 strike. You'll recall had a bid price of 835. Now let's go to the bottom section where you actually get the calculations.
Yeah.
Now in the blue circle to the bottom left shows you that if taken through expiration, it's an 18-day trade. Now let's look at the top row on the bottom. That is eBay, the lower volatility security, generated 1.59%, and based on an 18-day trade, 32.29% annualized.
Yeah.
Now the high IV security, Shopify, generated an 18-day return of 7.01%, 142.2% annualized. Both of them had upside potential of about 1%, which you can make an additional 1% if the stock moved from current market value up to or beyond that slightly out of the money strike. Now you could see clearly that the implied volatility has a huge impact on the premium returns you get when you're doing covered calls or cash secured puts, but yet Shopify would represent much greater risk to the downside if the price went down.
Yeah, because you'd have that much downside. That's I mean, those numbers show it all right there. And some people might say to yourself, wow, but I could earn 7 and 142. You also can lose 7 and 142 very quickly too. There is both sides to the trade. If it goes your way, like you said, it works very well to that side. If it goes the other way, it can turn around very quickly on you. This is a great slide that really does show you all of it right there.
You have to define what your personal risk tolerance is.
Yep.
You can't be like a deer in headlights going, I better call Howard or Allen to figure out what strike I want to use. If I'm willing to incur the risk where I'm generating 2 to 4% a month, that's my comfort level. It's risk, but it's low risk. Then it'll guide you right to the right strike. You won't have to be thinking, what should I do? Okay, I want 2 to 4%. It's a normal to bull market. I'm going to go out of the money. Or I wanted 2 to 4%. I'm concerned about the market. There's a Fed announcement coming up, or tariff concerns, or whatever it happens to be. I'm going to be defensive. I'm going to get my 2 to 4% with an in the money strike. And there you go. You won't have to be scratching your head. You'll know exactly what to do.
Absolutely. And I will point out, I was talking with Alan earlier today, before we came on, about a show that we're going to start doing on QUASAR that I'm looking at doing with wheel trades. And that's exactly what he said to me. I asked him some questions and he said, Howard, what are your risk dynamics you're looking to play with? Because that's going to lead you along the way. And he really did. Sometimes even someone like myself who's been doing this for a while, we get ahead of ourselves. Just take a deep breath sometimes and think it through. As soon as he said that, all the wheels went off. And I said, oh, yeah, that's right. Every way, all the guideline, all the sheets that you've put together puts you to that spot. It was like you mentioned a little bit earlier, where you don't really need to look at every trade necessarily your implied volatility, because if you're following your guideline of that 2 to 4% per month, by the way that the math works, your implied volatility is going to fall into that right range also.
Absolutely correct. And, that's one of the reasons, Howard, where I never tell anybody what to do. I have no right to impose my feelings, my thoughts, my personal risk tolerance on others. Other people may be more conservative than me, or much more aggressive than I am. There is no right or wrong, but you must decide ahead of time before you craft your trades as to where you stand, how much risk you're willing to incur, and then from there it's easy.
Absolutely. But I will point out how important that is. I almost was looking at making that mistake, going into something, not starting in the right spot. Again, what is the goal of the trade you're trying to make? What are you trying to do? Helps guide you along the path of where you're going to go. Right.
Yes, sir. That's it in a nutshell. That's saying it all.
As we get here into the discussion points.
Okay, well, I mean, basically, again, just to summarize, Howard, of the five Greeks, Delta, Theta, and Vega are the three critical ones. We want to understand the concepts, how these factors impact our trades. We don't necessarily have to look up the specifics. We don't have to look up what the theta amount is. We have to understand how implied volatility. We talked about that a lot today. Delta, we have to understand there's three definitions to delta, how they impact our premium, and also the approximate probability of exercise. A third one relates to high wealth portfolio managers. And the Greeks are very important in helping us craft our trades and in terms of managing our trades. I made a brief discussion before about hitting a double versus rolling down, depending on where we are and delta and so on and so forth in the trade. So Greeks is super duper important, but it's not always critical that we look them up. Just understanding the concepts and then applying it to entry of our trades and then management of our trades.
Absolutely, without a doubt. What I love is there are so many different uses of the Greeks that people need to have. And what you did was really break it down on how it works for the BCI system for covered calls and what you should be looking at if you're trying to do a strategy like this, where we talk about it using your stock almost as real estate to earn rent and to earn income on a steady basis. Dr. Ellman, like always, thank you so much for coming in and sharing your knowledge with us here at Quasar Markets. I'm going to give everybody a sneak peek. We're going to go a little off the beaten track on our next week's talk. We're going to actually get a little into crypto. And Dr. Ellman is going to help me take a look at IBIT. I've been very interested in using his strategy as a longer-term strategy to acquire more Bitcoin for my children. And this is one of the ways I'm going to do it. And I'm going to bring you guys along on the journey. And Dr. Ellman is going to help me get started next week. So thank you so much, Dr. Ellman. Anything you want to say for your final words of the day?
Well, I just hope that that the information I'm providing is beneficial to your viewers. Quasar is doing such a magnificent job of disseminating information out there, and I just hope that I'm playing a small role in that. And thank you for inviting me to these sessions, Howard.
Absolutely. You're one of the pillars of our education system here. So happy to have you part of us. We'll see you guys next week here on